This is the most accurate way to spot directional bias. Let's take this chart for instance. So there are three key steps to take while trying to spot directional bias. The first one is time frame. Let's assume you want to find the daily directional bias. Start from the weekly time frame. Now what you're looking for on the weekly time frame is to know if the market is bullish or bearish. You're looking at the structure of the market on the weekly time frame. Then from the weekly time frame, you go down to the daily time frame. Now what you're looking for on the daily time frame is simple. You're looking for a trading range. You can use liquidity pools to get that. Now for instance, price moves in waves. So this is what I call a trading range. You already know that price coming from this zone. You have to determine if price is coming from this zone and where it is going to. If price is coming from here, it's going to this zone. You can use liquidity pools to find these zones on the market. You can use support and resistance. So this is what I mean by a trading range. You have to spot where price is coming from and where price is going to. Then once you've marked out a trading range, the next thing you should look for is the structure of the market. Like I said, from the weekly time frame, you've already determined the structure of the market. On daily time frame, you're also going to determine the structure of the market. Is the market going to be bullish? Given that you have a trading range, it's easy for you to determine, because if price is coming from this low, you already know that price has to get to this top before any other thing happens. So the structure of the market at that time is bullish. So it makes it easier for you to spot the structure of the market at a time, and that is what the trading range is for. So once you've gotten your trading range, the next thing you are going to spot is supply and demand zones. That is your point of interest. You have to spot the supply zone and the demand zone, the area that you expect price to react from, or the area you expect price to come to you for. Let's assume that this is the market and you have this trading range and the price is currently here. You already know the price have gone from this bottom to this top, and let's assume that this was the trading range you found out, and you found out that there was a demand zone here. Automatically, you know that the directional bias of that daily time frame at that time, given that number one, you determine the market structure of the price, which is the structure of this market is bullish. Like I said, structure of the market is bullish and price is in a trading range and it's on a demand zone that you've already marked out, and you know that price being on this demand zone has to buy to this top. Then having the price is in a demand zone, you already know that price is most likely going to buy from this zone, and that's how you spot a directional bias. Yes, most people will come out and tell you directional bias, price is bullish, you're making higher highs and higher lows, so you're in a bullish trend, so the directional bias of the market is bullish. That is not how you spot directional bias. But then if you use this information that I just shared with you right now, you are going to determine the actual price directional bias on the daily time frame, on the weekly time frame, on the hourly time frame. It works on every time frame. So this is how you spot an actual directional bias. Don't let anybody deceive you that it's higher lows. I have a mentorship program where I teach people market structure, supply and demand, and literally everything you need to be profitable in the Forex market. And also join my Telegram group to learn more trading advice. The link is in the bio.